Hello, Sage Seed. I'm a professional value investor, and today I'd like to go through the latest annual report of Alliance Resource Partners together. I've never seen this report before, but I am going to treat this just like I do for my day job. A very serious analysis, real professional value investment. Let's dive in so that our wisdom can blossom. So let's go right into the opening move. Item 8, the numbers, the consolidated balance sheets. Now, this company is still on 2022 numbers. This is the latest that is available. And in the latest year, the ratio of assets to liabilities is about 2.6. This implies a defensive company. What do we mean by defensive? Company not trying to grow right now. Income statement. Not trying to grow, you say. How come revenue's growing so quickly? Well, that is a good question. Let's try to start to understand it. Operating expenses have been growing more than you would expect based on the balance sheet as well. But yes, the revenues have grown significantly faster than the expenses. Earnings per share is now over $4, whereas just 2 years ago, this company was actually losing $1 per share for every single shareholder. How are they doing it? Well, now let's look at the cash flow statements to keep figuring this out. Depreciation coming down, but not by any crazy number. Depreciation comes down. We're usually thinking that means that the business is doing less. But a lot of what's going on is in the working capital management, this section right here. I draw your attention to the first row, trade receivables. Very significant, large positive number a couple years ago. In the latest year, an even more significant, very significant negative number. Now, when it is negative number on the working capital management, this means working capital is reduced. We call that free cash flow. As you can see reflected at the very bottom here, net cash provided by operating activities, this is almost 800 million now. Twice what it was 2 years ago. This is more impressive than all the other things we've seen so far. So in conclusion for the opening move, this is a good story. I just don't know the details of the story yet. What does this company do? Why do they deserve to be making so much money? The management must have some idea of what they're doing to earn this. If we can check these two things and nothing seems untoward, then maybe this is just a good story. Very early on in the notes to the numbers we just looked at, a section titled Oil and Gas Acquisitions. This is a similar concept to being a landlord. Does Alliance Resource Partners mine oil and gas? No. Do they own the acreage upon which other operators want to mine oil and gas? Very much. Alliance Resources owns very desirable places to mine. They do tell us the names of these places: Boulders, Belvedere, Jace, different plots of lands positioned in the Permian Basin. I don't know what that is, but I can know numbers. They now own over 61,000 royalty acres. This is what it means to be a part of this business. As discussed, we're now in the item 7. This is the CEO's office message to investors. Once a year, they prepare this part of the annual report to tell us about the strategy. Now, while they do own acreage, management's actually using the first paragraph of the executive overview to talk about being the second largest coal producer in the eastern United States, operating 7 mining complexes. And so while the CFO's office seemed most proud about rent collection, CEO's office is immediately starting us off saying, actually, no, let's remember that the strategy here is to be really good at mining coal. Ooh, confirming here, Permian Basin apparently is Delaware and Midland. Now, Delaware is a state. Pretty sure Midland is not a state. Oops/stack. Definitely not a state. Try to trick me. Much further down in the item 7, the CEO's office finally admitting what the CFO's office was just saying immediately. We are dependent on third-party operators for exploration, development, and production of oil and gas. You can tell how someone interested in coal mining might get interested in working with third parties for oil and gas, but they don't have to be bundled together. The breakdown here a little bit later, this is now the actual breakup of how these two businesses come together. Coal sales close to 20 times larger than the oil and gas royalties. CFO's office was very excited about this row. Management, we now see somewhat justifiably, immediately was just talking about the strategy of this row. Coal sales does seem to have been around for many, many years. It was, as the CFO department was stating, it was the oil and gas royalties, the acreage, the significant acreage that they just acquired in the last 2 years that has changed the business. And that part of the business is still relatively small. Returning to the income statement, do not forget that coal sales was almost $1 billion less just 2 years ago. But maybe more importantly, depreciation is now less this year than it was 2 years ago. Hey, if you're getting more comfortable uncovering the stories behind the numbers, please like and subscribe. And so a mining company actually accounting for a lower level of mining activity, that's what this depreciation means, as it transitions towards a more royalty-based sales channel, which just naturally has less operating expenses attached to it. There is a mix going on there. Let's not get bogged down in the details. Let's step back and realize that in these commodity-like businesses, you can have success or the opposite of success, very much based on factors outside of your control. In this business's case, the price of coal. We can pull that up in a second, but before we even care about that, what is the company doing with its success? Because remember, $1 billion more in coal sales compared to just a couple years ago, and I'm rounding up a little bit, but still a lot more coal sales without mining a lot more coal. With this success handed to them by external forces, the CFO's office implying that they need to use this opportunity to make its business model fundamentally different in the future. Royalties are not the business that has gotten this company to where it is today. I don't know, the CEO and CFO offices not being in harmony is probably the biggest takeaway that I'm getting from this report. Now, I did say all this without even knowing anything about the price of coal, bit of a risk there, but we looked it up, check it out. Here, coal sales, $1 billion less. Surprise, surprise, by the time we're reporting just about here, coal sales have gone up significantly. This blue line, price of coal, didn't mine more coal. The price just went up. Now there's a bit of a crack in the management and financial offices. What do we do with this prize that has been dropped on our laps? My sixth sense for valuing commodity businesses is not very finely tuned. I'll admit that. I don't know, prices up, down, flipping around. I can't move my head all the way over there, but it's a lot. However, there's a fundamental business that's been around for years and years underneath all that crazy external stuff. Let's call in Sage Seeds AI. Sage Seeds AI can give us a ranking relative to all the other companies that are in its input. Remember that this channel is all about figuring out the story behind the numbers with me, and then let's try to guess whether the Sage Seeds AI is going to see this as high or low value. A high ranking means high value, low ranking means low value. The Sage Seeds AI is trained to identify value investments. I don't really know where it is. I don't have a clue. ARLP is ranked 526 out of 620 in value for the 2022 season. We're late in the season, and this company has scored in the 85th percentile. Not a good ranking. I wish them luck converting to a more stable source of revenue, which is what the CFO's office is really probably excited about when they're focused on royalties. But with the CEO's office not even convinced, it's going to be interesting to see how this company develops in future seasons.